Not all investments are created equal. Some are safer, some offer higher returns, and some are better suited to your personal goals and timeline. Understanding these differences is the first step toward building a portfolio that truly works for you. Let's start with one of the most common and widely used investments, stocks. When you buy a stock, you're purchasing a share of a company, meaning you own a small piece of that business. If the company grows, innovates, or increases profits, the value of your share can rise.
Over the long term, stocks have historically provided strong returns, often outpacing inflation and other asset classes.
However, stocks can be volatile. Prices may fluctuate daily due to market news, economic changes, or company performance. That's why it's important to take a long-term perspective. For example, if you invested in a diversified mix of stocks during a market dip, the value of your investment might fall temporarily. But historically, markets tend to recover over time, and patient investors can benefit from growth over years and decades. Stocks come in different forms: blue-chip stocks, growth stocks, and dividend stocks.
Blue-chip stocks are shares in large, established companies with a history of stability and dividends.
Growth stocks are companies that reinvest profits to expand rapidly, offering higher returns but carrying higher risk.
Dividend stocks pay regular income to investors.
Depending on your goals and risk tolerance, a combination of these types can make up a strong stock portfolio. Next, let's explore bonds. Bonds are essentially loans you give to a company or government.
In return, they pay you interest over a set period of time, and at the end, they return your initial investment.
Bonds are generally considered safer than stocks because they provide predictable income and are less sensitive to market swings. Bonds vary by type: government bonds, corporate bonds, and municipal bonds. Government bonds are backed by the issuing country and tend to be very secure. Corporate bonds are issued by companies and may offer higher interest rates, but they carry slightly more risk. Municipal bonds are often tax-advantaged in certain regions. For beginners, bonds provide stability and can balance the riskier portions of a portfolio, like stocks. An easy way to visualize the difference between stocks and bonds is to imagine a roller coaster versus a train. Stocks are like the roller coaster, thrilling with ups and downs, but potentially very rewarding. Bonds are like a train, steady, predictable, and less likely to make sudden drops. A combination of both can help create a balanced investment experience. To give a practical example, imagine you invest $1,000 in a diversified stock portfolio and $1,000 in bonds.
Over 10 years, the stocks may grow faster, but also experience dips.
The bonds may grow slower but remain stable. Together, they smooth out volatility while still giving growth potential. Remember, understanding how each asset behaves is crucial before you start investing. The first step is education. Know what you're buying, what risks it carries, and how it fits your personal financial goals. Stocks and bonds form the foundation of most investment portfolios, and mastering them will make it easier to understand more complex assets later on. Finally, think about your goals and risk tolerance. Are you investing for retirement 30 years away or for a down payment on a house in 5 years? Longer timelines allow more exposure to stocks, while shorter goals may benefit from safer investments like bonds. There's no one-size-fits-all answer, but knowing the basics of stocks and bonds gives you a strong start. Now that we've covered stocks and bonds, let's move on to ETFs and index funds, and then explore real estate as another important investment option. ETFs, or exchange-traded funds, are essentially baskets of investments.
Instead of buying individual stocks or bonds, you buy a single fund that holds dozens or even hundreds of assets.
One of the most popular examples is an S&P 500 ETF, which includes shares from the 500 largest U.S. companies. By investing in an ETF, you gain exposure to the entire market with a single purchase. This diversification reduces the risk of losing money if one company underperforms. Index funds work similarly. They track a specific market index, like the S&P 500 or a total stock market index. The goal isn't to beat the market, but to match its performance over time.
For most beginners, ETFs and index funds are ideal They're simple, cost-effective, and historically provide steady growth.
You don't need to spend hours researching individual stocks. The fund automatically spreads your investment across many companies. Let's look at a practical example. Suppose you invest $500 in an S&P 500 ETF today. Historically, the S&P 500 has returned around 7% annually after inflation. That $500 could grow to approximately $1,000 in about 10 years. Add monthly contributions, and your investment compounds even faster. This demonstrates how diversification and long-term investing work hand in hand.
Next, let's explore real estate. Real estate investing involves buying property, like houses, apartments, or commercial buildings, with the goal of generating income or appreciation.
Real estate can provide rental income while the property value increases over time. Unlike stocks or ETFs, it's a tangible asset you can see and touch.
Real estate has several unique advantages. First, it often acts as a hedge against inflation. As prices rise, property values and rental income typically increase as well.
Second, leverage is commonly used in real estate, meaning you can borrow money to invest, potentially amplifying your returns.
However, it comes with risks such as market downturns, vacancies, and maintenance costs. Liquidity is an important factor here. Unlike stocks or ETFs, real estate is not easily sold.
It may take weeks or months to sell a property if you need cash quickly. That's why real estate is better suited for long-term investors who can hold assets over several years.
A practical approach for beginners might be to allocate a small portion of their portfolio to real estate, either through direct property ownership or through real estate investment trusts, which allow you to invest in real estate without buying physical property.
REITs function similarly to ETFs, offering diversification, income, and growth potential.
Think of ETFs and real estate as two different ways to grow wealth. ETFs offer easy access, liquidity, and market diversification, while real estate offers tangible assets, potential income, and a hedge against inflation.
Both can complement your portfolio when used wisely. When combining these assets, balance is key. You might allocate a portion of your portfolio to ETFs for steady growth, a smaller portion to real estate for long-term appreciation and income, and still maintain stocks and bonds to diversify risk. The combination depends on your goals, time horizon, and risk tolerance. To summarize this part, ETFs and index funds simplify investing while reducing risk, making them ideal for beginners.
Real estate offers tangible, long-term growth and income opportunities, but requires more time, research, and patience.
Understanding both allows you to build a diversified, balanced portfolio that aligns with your personal financial strategy.
Welcome to our deep dive into investment portfolio strategy, focusing on how cryptocurrencies fit into the modern financial landscape. Today, we'll explore the unique characteristics of digital assets and how they compare to traditional investments, helping you make informed decisions. Finally, let's look at cryptocurrencies, a newer, digital form of investment that has gained significant attention in recent years. Cryptocurrencies like Bitcoin and Ethereum are decentralized digital assets that can offer extremely high returns, attracting many investors. However, they also come with very high volatility and risk, making them a complex addition to any portfolio. Prices can swing dramatically within hours or days, which makes them suitable only for investors who truly understand the market and can tolerate significant fluctuations. Cryptos are often considered speculative investments, meaning their value is largely driven by market sentiment and future expectations. While some investors have made substantial gains, others have experienced large losses, highlighting the importance of caution. Therefore, if you choose to include cryptocurrencies in your portfolio, it's wise to allocate only a small portion and never invest more than you can afford to lose. Think of crypto as the high-risk, high-reward portion of your investment toolkit, designed for potential exponential growth, but with inherent risks. Now, to make all these asset types easier to compare, let's create a simple risk, return liquidity table. This table clearly shows that no investment is perfect. Each comes with its own set of trade-offs. High returns usually come with higher risk, and more stable investments often provide lower growth, a fundamental principle of investing. Liquidity, how easily you can access your money, also varies across assets, impacting your financial flexibility. The key takeaway is this: the best portfolio is the one that fits your personal situation, not a generic template. Your age, goals, timeline, and comfort with risk determine the right mix of assets for your unique financial journey. Some people prefer a conservative portfolio with more bonds and cash for stability, prioritizing capital preservation. Others take a more aggressive approach with stocks, ETFs, and a small portion of crypto, aiming for higher growth. Real estate can provide tangible value and additional income, but may require more patience and active management. Diversification is your ally. It's the cornerstone of a resilient investment strategy. By spreading your investments across different asset classes, you reduce the risk of a single investment hurting your overall portfolio. For example, if stocks fall but bonds and ETFs remain stable, your portfolio is cushioned against major losses, maintaining balance. Adding a small portion of real estate or crypto can further enhance growth potential without taking on excessive risk if managed wisely. Let's illustrate with a hypothetical example. Suppose you create a balanced portfolio consisting of 40% stocks, 30% bonds, 20% ETFs, 5% real estate, and 5% crypto. Stocks provide growth, bonds offer stability, ETFs give diversification, real estate adds income, and crypto adds potential high reward. This combination aligns with moderate risk tolerance and long-term growth, offering a well-rounded investment approach. Finally, investing is not about copying someone else's strategy or blindly chasing the latest trend. It's about understanding the assets, your own goals, and creating a personalized plan that works specifically for you. Take the time to educate yourself, start small, and gradually build a portfolio that reflects your unique needs and aspirations. Remember, there is no one-size-fits-all portfolio. Customization is key to success. The right approach is the one that matches your goals, risk tolerance, and timeline, ensuring long-term comfort and confidence. With patience, consistency, and knowledge, you can create a portfolio that grows steadily and supports your financial future. In conclusion, understanding different types of investments, stocks, bonds, ETFs, real estate, and cryptocurrencies, and how they interact is the key to smart investing. Take the time to plan, diversify, and build a strategy that suits you, ensuring your financial well-being. The best portfolio is the one that fits you, and that's the path to long-term financial success and peace of mind.